Hi folks, myself Raj. Welcome to our channel Code Shack. Thanks to everyone for watching our podcast show. And today is episode number 21. Our discussion topic is options trading and how it works. So let's start our discussion. What is option trading? Options are in general financial contracts that gives the holder the right to buy or sell a financial instrument at a specific price for a certain period of time. Options available for numerous financial products such as stocks, then funds, then commodities and indexes. Options are contracts that gives the bearer the right but not the obligation to either buy or sell some amount of some underlying asset at a predetermined price before the contract expiry. The three main or the three key features of option, they are strike price, expiration date and options premium. So let's discuss about strike price. This is the price at which an option can be exercised. Then expiration date. This is the date which an option expires and becomes worthless. Then options premium. This is the price at which we can buy an option. Options are like an effective way or effective tool for hedging against a declining stock market to limit your downside losses. Hedging with options is meant to reduce risk at a reasonable cost. We can think of using options probably like an insurance policy. Imagine that you want to buy technology stock, but you also want to limit your losses. So, how are you going to do that? You can use options. You could limit your downside risk and also cost effectively enjoy all the upside. Also, for short sellers, call options can be used to limit losses if the underlying price moves against their trade, probably during a short squeeze situation. Options can also be used for speculations. A speculator might think that the price of a stock will go up, perhaps based on some on fundamental analysis or maybe on technical analysis. So the speculator can buy a call option on that stock. Speculation with call option gives the speculator an extra leverage as it doesn't need to buy the stock outright. An out of money call option may only cost a few dollars or even cents compared to a full price of a stock, probably $100 or can be even more. So, in terms of valuing an option, how can we value an option? So, valuing option contract, it is essential to determine the probability of future price events. Uh, More likely something to happen, the more expensive the option can be. Like a call value can go up as the stock or the underlying asset price goes up. Then we have to think regarding the time value. So less the time there for option expiry, less the value of option will be. This is because the chance of the underlying asset diminishes as we draw closer to the expiry. Like there may be probability of more or less fluctuation of the price of the underlying asset as it draws closer to the expiry. So, for example, if you buy an out of money option for a month to expire and the price of the underlying asset doesn't move, then what is going to happen? Then the option becomes less valuable with each passing day. This happens because time value is one of the most important component for option pricing. A 1 month option is going to be less valuable than a 3 month option. Just because of the available time, the probability of the price of the underlying asset may increase in favor or can decrease. And less the time the option has, it is less valuable. So, an option with a strike price that expires a year from now will be costly than an option strike price expiring within a month. This is also known as time decay. Another important component is the volatility. Volatility increases price of an option. This is because uncertainty pushes the odds of an outcome to higher. So if the volatility of the underlying asset increases, then large price swing is on the table. It can be both up or down. Greater swings eventually increases the chance of an event occurring. Therefore, greater the volatility or vega, greater the price of the option. So we have to remember option trading and volatility are intrinsically linked to each other. And an option premium is the combination of its intrinsic value as well as time value. Uh, there are two types of options. One is call option and another one is put option. A call option gives the holder a chance to buy a stock. So it becomes more valuable when the underlying asset price increases. So let's discuss an example. You are thinking that the price of Tesla going to reach $250 in coming 10 months. But you don't want to invest a lot of cash or you don't want to buy Tesla outright. So you bet on an out of money call option with a strike price of $200. This saves your cash and also give you the chance to enjoy the upside gain if the Tesla reaches $250 in coming months. Also, it gives you the option to exercise if you want in coming 10 months if the stock price reaches $250. Then comes the put option. Put option gives the holder a chance to sell a stock. So it becomes more valuable when the underlying asset price falls. So let's discuss an example. You are thinking that the price of Tesla going to reach $100 in coming 10 months, but you don't want to hold a short position. So you bet on a put option that gives you a chance to sell the option at any time in coming 10 months. If the Tesla price crashes $100, that gives you an option to enjoy the position you don't want if you don't want to buy. So think it like this way that the call and put option gives you the power to hedge on any stock or the entire market, giving you the privilege to either enjoy upside when with a call option or enjoy the downside with a put option. If you are new to the option world, take your time to understand uh, the intricacies and practice before putting down serious money. So that's everything for today. Hopefully, you guys enjoyed our today's podcast. Please keep watching our podcast and keep sharing with your friends and family. We will try to bring in more financial topic that will help you to save money from borrowing and also keep you one step ahead from your lenders. Have a wonderful rest of your week. See you again in our next episode. Thank you.